the other side of the currency is the debt, and the debt is growing, and they can't let the debt be liquidated because if you do, everything implodes on itself. So I can't tell you what price gold is going to be or silver, but I think, yeah, they will be higher, a lot higher going forward. I think 2024 has been a pleasant surprise for gold. Maybe not so much for silver, even though silver is up. If you look back to 2000, the average increase every year has been around 9 to 10%, depending on the major on depending on the currency that you look at. So yeah, that would be my best guess. Maybe a 9 to 10% increase in gold, and I think silver will outperform this year gold.
In its recently published 2025 Commodity Outlook report, TD Securities commodity strategists projected that silver prices will once again outperform gold in 2025, with the average spot price during the final months of the year reaching $36 per ounce. This bullish prediction is primarily based on expectations of rapid economic recovery in both China and the United States, which will likely accelerate inventory depletion, coupled with sustained demand growth from the solar energy sector. Seasoned financial expert Mario Innecco sees 2024 as strong for gold and expects silver to outperform in 2025 with a potential 20 to 30% rise. He mentions gold's consistent performance since 2000, suggesting another strong year ahead for precious metals. Based on fundamentals, Innecco explains that gold and silver represent the flip side of fiat currencies, emphasizing the growing global debt burden. Total debt outstanding has surged to $36 trillion from $19.5 trillion in 2016. Or approximately 120% of gross domestic product from 105%. However, Innecco foresees a second wave of inflation driven by U.S. and China fiscal policies, with the U.S. running a near 7% GDP deficit despite no recession. He links rising gold prices to de-dollarization and non-Western central bank actions, signaling potential commodity gains. Many countries, especially those sanctioned by the U.S. and its Western allies, seeking to reduce their reliance on the U.S. dollar have turned to gold as an alternative asset. At the same time, investors are worried about the U.S. public debt ballooning to $36 trillion, or about 99% of GDP. This trend has been driven by concerns over the dollar's stability and the desire for greater financial sovereignty. As a result, the demand for gold has surged, pushing prices higher. Concurrently, Innecco predicts that central banks will respond to market or economic troubles with aggressive rate cuts and potentially a return to quantitative easing. Now we present the clips of Mario Innecco's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I don't see any change in the fiat currencies because gold and silver are just like a flip side of the currencies. Gold and silver used to be money, so we've got a problem with debt. The currency these days, the other side of the currency is the debt, and the debt is growing, and they can't let the debt be liquidated because if you do, everything implodes on itself. So I can't tell you what price gold is going to be or silver, but I think, yeah, they will be higher, a lot higher going forward. I think 2024 has been a pleasant surprise for gold. Maybe not so much for silver, even though silver is up. If you look back to 2000, the average increase every year has been around 9 to 10%, depending on depending on the currency that you look at. So yeah, that would be my best guess. Maybe a 9 to 10% increase in gold, and I think silver will outperform this year gold. So maybe 20 to 30%, I would say. Yeah, I mean, the central banks that are moving the price are the non-Western central banks. So I think that's a symptom of the de-dollarization, and I think that also is going to continue. And I think it's pointing to another leg up in the general commodity prices, because if you look at the major commodities outside gold and silver, they haven't had such a good year as gold. And yes, I think we're going to have a second wave of higher prices, or what some people call inflation, going forward. I think we're already seeing a driver from fiscal policy in the U.S. deficit in the last fiscal year was almost 7%, which is crazy when you think that the economy was not in a recession. And you've seen China recently also, they're trying to accelerate not just their monetary policy, but their fiscal policy. So all those two things are going to drive it. And I think if we do have some kind of trouble in the markets and the economy in the next few months, the central banks are going to step up and start cutting even more aggressively, and also maybe even restart QE or money printing.
During the interview, Mario Innecco expects ongoing monetary accommodation, rising U.S. debt, and continued deficit spending, with little chance of government efficiency reforms. He foresees a weaker dollar as BRICS nations reduce dollar reserves and declining fiat purchasing power. While Trump's deregulation could lower energy prices, Innecco emphasizes the value of gold, silver, and hard assets. As of now, gold prices are still hovering at high levels. Trump's presidency could impact this one way or the other, depending on his economic policies. If he pushes for aggressive spending or trade reforms, investors might turn back to gold, pushing prices higher as demand rises. Furthermore, Innecco observes that a U.S. recession would impact global markets, but weaker economies like Western Europe and the UK may relatively underperform less. He advises prioritizing hard assets, commodities, and mining sectors, with Canada and South America offering opportunities. Let's get back to the interview.
Well, I expect more of the same. If the system holds, we're going to see continued accommodation monetarily. We're going to see continued spending by Uncle Sam. I don't think Elon Musk and the other fellow are going to be able to control government spending. I think they tried it in the 80s. I saw Steve Hanke speaking the other day that he worked in the Reagan administration. Had something called the Grace Committee to drive efficiency and cut the size of government, and it doesn't work. Washington, D.C. is it's not that easy. It's not like running a business. So I expect the dollar to weaken as well. And I expect continued deficit spending and continued growth in the debt. I think maybe the general public, the bottom 90%, will be a bit better off. I think Trump will deregulate. He will allow energy extraction, and that could help the price for energy to come down. But I think it's going to be hard for the U.S. In terms of the dollar, because I think the BRICS, under the leadership of the Chinese and the Russians and other countries, they are continuing to divest of their dollar reserves, especially with the threats that Trump has made about tariffs going forward. So yeah, it's going to be a weaker dollar. The economy will do well nominally, but in real terms, I still think people who hold fiat dollars or Federal Reserve notes, they're going to be losing out in terms of purchasing power, and that's why I keep going back to talking about gold and silver and hard assets in general. And I'm much more convinced that they're about to outperform like the general stock market, because they're totally undersold, and I think tech is just a bit overdone. Well, I think the rest of the world is underperforming already. So, in relative terms, if America goes into a recession, yeah, and I think the rest of the world, like especially Western Europe and the UK, we're already in a recession, and our markets haven't performed as well. So I think in relative terms, we won't do as badly as the US. The US has a lot more to lose. It reminds me of Japan just before the end of 1989, when the Nikkei topped and only reached that level this year. It took 40 years. So that's what the US reminds me of. I try to look at not where to put capital, but in terms of assets. I'm still, as I've said, hard assets, commodities, and also gold and silver. I guess you could look at some countries. It's getting harder and harder to invest because, for example, Russia is the biggest has the biggest commodity reserves, but we can't really invest there now. And the world's getting so geopolitically fractured. Globalization is like falling apart. So I'd stick to like Canada, maybe some South American countries, and the mining sector and commodities like soft commodities, hard assets. And maybe Europe will outperform, even though Europe is looking really bad. Who knows? We are ahead in our kind of meltdown. But yeah, I wouldn't look to geographically too much, but diversifying as well is important if you're going to invest in the stock market, I would say.
The firm, which conducts a regular survey of its customers, forecasts gold will reach a high of $3,070 in 2025, with respondents citing geopolitics as the biggest factor driving their interest in the yellow metal. How might rising global debt and de-dollarization reshape the role of precious metals in investors' portfolios, and which regions or sectors offer the most resilience in this evolving economic landscape? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.